Retail. Hi, I'm Retail, and I'm here to ask the questions you're probably thinking.
And I'm Quan. Today we're going to crack open the mathematical engine that really powers all of modern finance, the Black-Scholes model.
I've always heard it's just this incredibly complex formula, but you're saying there's a real story here?
Oh, it's more than that. It's a story about trying to tame uncertainty itself.
Okay, let's just dive right in. For me, this all starts with what feels like an impossible question. How do you put a fair price today on the right to buy, say, Apple stock at a fixed price 2 years from now? I mean, the future hasn't even happened yet.
That is the central problem. And for centuries, pricing that right, it was basically guesswork, intuition. You could call it a dark art. And then, in 1973, Fischer, Black, Myron, Scholes, and Robert Merton, well, they found the light switch.
Retail. So what's the roadmap for this explainer? How are we going to break this down? Quan, we'll start with the pricing puzzle that everyone was facing. Then we'll get into their riskless revelation, the core idea. After that, we'll see how this formula became an actual engine for the markets, explore the day it all broke, and then finish up with the lessons from this flawed but absolutely brilliant piece of financial engineering.
All right, Act 1, the puzzle. To really appreciate the breakthrough, you have to understand the world before it. Pricing an option was, frankly, a chaotic affair. Traders used rules of thumb, gut feelings, maybe some rough models, but there was just no universal logical standard.
Retail, it seems like options have been around forever though, right?
Quan.
Oh, they have. People were trading them in Amsterdam coffee houses way back in the 1600s, and you had academics like Bachelier modeling them in 1900, but the core problem never, ever changed. To price an option, everyone just assumed you had to predict the stock's future direction. And of course, no one could agree on that. Then, just as the theory was getting hot, the CBOE opened its doors, creating this huge liquid market that was absolutely desperate for a real solution.
Now, what's really fascinating here is you can see two different camps closing in on the answer at the same time. On one side, you've got Ed Thorp, the famous card counter who beat Vegas. He was a practitioner, an arbitrage hunter. His goal was simple: find mispricings and make money. He believed his hedge portfolios could, and did, earn much more than the risk-free rate.
Right, he was looking for an edge.
Exactly. Black and Scholes came at it from the complete opposite direction. They were theorists, applying things like the capital asset pricing model. Their goal was elegance, a universal truth. They started with this really bold assumption: in a perfect market, a perfectly hedged, totally riskless portfolio must earn exactly the risk-free rate, no more, no less. Because any other result would be an arbitrage opportunity that the market would instantly wipe out.
Retail, a perfectly hedged portfolio. Okay, that sounds like the magic trick, so what was the big revelation here?
Quan. This is the core of their genius. Instead of trying to predict the future, they found a way to make the future completely irrelevant.
They constructed this theoretical portfolio. So imagine you buy some stock, and at the very same time, you sell a call option against it. Now, for any tiny move in the stock price, up or down, the options price will also move, but not by the same amount. The key was finding the exact ratio of stock to options so that if the stock ticks up, the gain on your stock is perfectly canceled out by the loss on your short option position. And what if it ticks down? The loss on your stock is perfectly canceled by the gain on your option. For a brief moment, your portfolio's value just doesn't change. It's completely riskless.
Right. And this process has a name. It's called delta hedging. Delta is just the rate of change of the option's price relative to the stock's price. So if an option has a delta of 0.5, it means for every dollar the stock moves, the option price moves 50 cents. To hedge 100 shares of stock, you'd need to sell 200 of these options. The real trick, though, is that delta isn't constant. It changes as the stock price and time change. So in theory, you have to be continuously rebalancing this hedge.
And here is the earth-shattering conclusion. When they built this perfectly hedged, riskless portfolio and derived the math that described it, something amazing happened. The variable for the expected return of the stock, the part that represents predicting the future, it completely canceled itself out. It just vanished from the final formula. As Fischer Black himself said, rather suddenly it came to us.
Okay, hold on. That's wild. So you are telling me that the fair price of an Apple option has literally nothing to do with whether you think Apple is going to the moon or going to zero. Precisely. It only depends on things you can observe right now today: the current stock price, the strike price, the time left until expiration, interest rates, and one crucial unobservable variable: volatility. They had solved the puzzle.
So the model gets published in 1973, the very same year this CBOE opens. Now, you'd think it would be like a camera, just taking a snapshot of how prices behaved. But it turned out to be far more powerful than that. It actually became an engine that drove the market.
What do you mean by that? An engine, not a camera. It's a concept called performativity. Think of it like this. A camera just records a football game as it happens. An engine changes the rules of the game itself. The theory didn't just describe the market, it completely transformed it. When every trader on the floor started using the same formula to price options, they forced the actual market prices to align with that formula. The map started to redraw the territory. Before 1973, if you asked a trader for a price, they'd shout back a number. That option's 5.25. It was just a price, in dollars and cents.
But after Black-Scholes, everything changed. Traders started quoting prices in a totally new way. They'd say something like, I'm a buyer of Apple calls at a 28 vol. The price wasn't a dollar amount anymore, it was a level of volatility.
Okay, so what is implied volatility? Quan? It's the secret sauce. See, since you know every other input in the formula, stock price, strike, time, interest rates, and you can see the actual price the option is trading at in the market, you can just run the Black-Scholes model backwards to solve for the one missing piece, volatility. It's the market's consensus forecast of how much the stock is going to bounce around in the future. It literally became the universal language for options trading.
Retail, so it really sounds like they created this perfect system. A beautiful theory, a new language for the market. I mean, did it just work perfectly forever?
For about a decade it fit remarkably well. But then, on one of the most infamous days in market history, the elegant math of the model collided with the raw, messy fear of human reality.
October 19th, 1987. Black Monday. The Dow Jones Industrial Average plummeted over 22% in a single day. The crash just shattered a core implicit assumption of the model, that stock price movements are random and symmetrical, following a neat little random walk. The market showed everyone that it could fall much faster and further than the model ever thought possible.
Retail. So what actually happened to the pricing itself? Well, in the aftermath, traders started analyzing option prices, and they discovered something that just shouldn't exist. A persistent, undeniable pattern that directly contradicted the theory. They called it the volatility smile, or sometimes the skew.
Okay, so the crucial point is this. The Black-Scholes model assumes a single constant volatility for a stock. So if you were to plot the implied volatility against different strike prices for all of that stock's options, it should be a perfectly flat line. The same volatility everywhere. Exactly. But after 1987, the line wasn't flat anymore. It was curved like a smile, or maybe a smirk. The options furthest from the current stock price, especially the put options that protect against a crash, suddenly had much higher implied volatility. The market was now pricing in a premium for crash risk. It was screaming that it was way more afraid of a big drop than it was hopeful for a big rally. The model's elegant world was officially broken.
Retail. This is just fascinating. The model is provably wrong, right? It doesn't match reality anymore. And yet I know from talking to traders that it's still on every single screen on Wall Street. What gives?
Quan. That is the paradox, and it's also the most important lesson. The model's value changed. It went from being a camera that was thought to capture reality to a tool used to measure the distance from that idealized reality.
Okay, so let's get right to it. If you know the smile exists, why on earth do you still use a formula that predicts a flat line?
Because it's still the best ruler we have. It provides a universal benchmark. It created the language of implied volatility, which is how the entire market still communicates. Traders today aren't really arguing about the correct price. They're trading the shape of that volatility smile. They're asking, is crash protection too expensive right now relative to the potential for a rally? The model's flaws actually became its most important feature. The real edge today isn't finding a perfect model. It's knowing exactly where your model breaks.
Retail, so it's about humility, in a way.
Exactly, and this quote illustrates that point perfectly. Even Fischer Black himself, one of the creators, tells this story about using the formula on a warrant trade and losing money. His conclusion was, the market knew something that our formula didn't know. That is the fundamental lesson for any data-driven investor. The map is not the territory. The model is not the market.
So we're left with a really crucial question. Black-Scholes was this elegant, human-designed engine that defined 20th century finance. But today, our markets are increasingly driven by incredibly complex, data-fed AI models. Often, they're black boxes we don't fully understand. It forces us to ask, what are the hidden assumptions baked into the algorithms shaping our world right now? And will we only discover them on the day they break? Retail, a sobering thought to end on. Thanks for joining us for this explainer.